Okay, I've got Amna Mohsen with me. Amna, you have got any questions you can ask. If you have got any questions you can ask, you can unmute yourself if you wish to, and you can even write down in the chat window, whatever that suits you. Over to you, lady. You can ask whatever you wish to.
Hi, sir.
Hi, how are you?
Good, sir. Thank you. How are you?
Good, good, alhamdulillah.
Sir, I would like to know, what do we need to know about the exposure draft? The new exposure.
Okay, do you have access to Kaplan?
Not the latest 2022 one. It's the 2021
2021. Yeah, you have access to Kaplan, right?
till June 2020. Yeah.
Okay, there is a chapter about the current issues. You could
Okay.
probably go through that, and there is also a YouTube video of myself about the current issues. You can review that also.
Okay.
That is available on my channel. It's Luqman Rafiq. You could just search onto that channel and you would find out there is a video on the current issues. In fact, I would just try to see if I could share the link of the current issues also.
Yes, sir. Thank you. Okay. So one more thing. What is the difference between onerous contracts and executory contracts?
Okay, basically what happens is onerous contract is in simple term a loss making contract. A contract which you know from an advance that this is going to be a loss making contract means you would end up having a loss with this contract. So that's what an onerous contract is. Now, when we talk about the executory contract is the contract which needs to be executed by one party before the other party is liable to perform. Like, for example, I tell you, till the time you don't deliver the goods to me, I will not be making you any payment. So that's an executory contract. That means the performance of one party is mandatory before the second party is required to perform. That's an executory contract. So the provision for onerous contract is actually required to be made, but for the executory contract, there is no such thing that needs to be done. It's only required to be recognized once the other party has performed.
Okay, so expenses as it's incurred, right?
Yeah.
Okay.
Any other questions from your side?
And in this question, the naval question, that 6 million is an onerous contract, is it?
Yeah, the 6 million is an onerous contract, and you got to recognize the provision for that.
So when we talk about the impairment on this naval question,
Yeah.
written down value, when we talk about that, do we talk about that we have to allocate the impairment on goodwill and
Yeah, you can elaborate that. You can elaborate that.
Important, or we can just talk about the main points? Is that necessary?
Well, you see, what happens is that there are many, you see, available marks are 6, and we already have talked a lot about it. So you see, I would say the maximum marks are 6, but the available marks might be 8, 9, because there are 8, 9 points that you can actually discuss over here. So ultimately what happens is that it's the 8, 9 points that are actually available to be written, and it's just that you got to write down 5, 6 points. So even if you miss out 1 or 2 of the point, that is okay, as long as you're covering the total points.
Okay. Thank you, sir. Thank you so much. Thank you, sir.
Okay, you have any other questions?
No, that's it. Oh, and sir, is sustainability reporting important for this for this session?
Well, you see, what there is not much with respect to sustainability reporting. Again, there is a YouTube lecture that is of sustainability reporting, hardly 10 minutes or 15-minute, right? That I have actually prepared. So you may actually try to look at that lecture again on sustainability reporting, and I would just try to share the link to that also.
Yes, sir. Yeah. Thank you so much.
Okay. Thank you. You may stay and listen to the other students' questions in case if you wish to, or if you wish to leave, you can leave, up to you.
Thank you. Thank you so much.
Thank you. We have got the next Adnan Mahmood Khan. Adnan, if you could just, if you have any questions, you may ask. Yeah, Adnan Mahmood Khan, do you have any questions? Your mic is not working. Okay, you may write down the question. You may write down the question in the chat window in case if you wish to. We've got, Alhamdulillah, I got what you tried. Okay, thank you very much, Adnan. Thank you very much for your feedback. Really happy to hear that. Okay, we've got the next one, which is Al Haji Baba. Al Haji, please go ahead. You may ask any questions if you have. Yeah, Al Haji, do you have any questions? I am unable to hear you. Okay, I want you to throw light on cryptocurrency. Okay, now let me guide you that what is it that you need to understand with respect to the crypto. Okay, what is it that you need to understand with respect to the crypto? Let's try to understand. Basically, in the past, the examiner have asked a question once with respect to the crypto, and his question was majorly that would it be accounted for as a financial asset or would it be accounted for as an intangible? How exactly are you going to account for it? Or would it actually be accounted for as a cash? What exactly do you need to do? Now, see, one thing with respect to the cash and the cash equivalents is that the cash and the cash equivalents are actually the financial assets. And when it comes to the cash and the cash equivalents, their value does not fluctuate. It's not like this that $1 would now become $5 tomorrow, or it will become $10 day after, or it will become $2 the second day, or it would become $0.3 another day. The dollar does not fluctuate like this. If you've got a dollar, it's a dollar. It's a single dollar. That's how it is. The dollar does not change. Now, when it comes to the cryptocurrencies, the biggest problem with respect to the cryptocurrencies is that they have got a volatility. They've got ample amount of volatility. And because of that volatility, unfortunately, the cryptocurrency does not fall under the definition of the cash or the cash equivalents. So therefore, the crypto cannot be categorized as a financial, cannot be categorized as a financial asset. That's one thing with respect to the crypto. Now, the second thing with respect to the crypto is that is it an intangible? So when it comes to an intangible asset, there is a definition of an intangible asset. And what is the definition of the intangible asset is that an intangible is identifiable non-monetary asset without physical substance. So the identifiable non-monetary asset without the physical substance. Now, so basically what happens is that non-monetary asset without a physical substance. So the arguments are actually like this, that the crypto might actually fall under the definition of this intangible. But still there is actually a big debate that needs to be made. So again, there is no such thing as what the crypto is going to be considered to be. It might be considered as it might be considered as an intangible, but it's for sure that it cannot be considered as a this financial asset. So when you have to account for the cryptocurrencies, all that you have to do is that you got to make sure that you keep in mind that the accounting for the cryptos is not very much clear till now. And since the accounting for the cryptos is not very much clear till now, so it's basically going to be a very judgment call, and the regulators and the accountants and the IASB is still not too sure that how to account for this cryptocurrencies. So that is something that is about the crypto that you should know. Okay. I've got other students who have actually put in some of the questions. I'll try to answer them also. Just wait a bit. Just let me actually try to get into the sequence. Okay. Julie, you would have to wait a bit, please. I'm sorry, you wait a bit. Okay, Anas Faruqi, do you have any issues? You have anything to ask? Yeah, Anas Faruqi, you have anything to ask? Asset ceiling, okay. Okay. So with respect to the asset ceiling, you see what happens is that when you've got the present value of defined benefit obligation, you've got fair value of plan assets. Usually what happens is, let's say this is 1,000 defined benefit obligation and the plan asset maybe, let's say 850. So resultingly 150 is the defined benefit liability. But in case if it happens like this is 1,000 and this is 1120. So resultingly you will end up getting 120. So this is actually going to be considered as a defined benefit asset. Now what happens is that IAS 19 puts a restriction on the amount of the asset that can be recognized. So what is the amount of the asset that can be recognized? So with respect to the IAS 19, it says that the asset that is to be recognized has to be the lower of amount calculated or the present value of benefits expected to be received in the form of refunds or reduced contributions. So basically, even though it's 120, but if this is turning out to be 80, so the maximum asset that you're going to be recognizing is 80. That's what the concept of asset ceiling test is, that you got to put a restriction to the amount of the asset that could be recognized. Okay. Okay, Anas, is there anything else that you would wish to ask? Yeah, Nadesan, just wait a bit, please, lady. Okay, good enough. Yeah, Blessing Juru. What is it that you want to know? Yeah, Blessing Juru. Impairment of financial asset. Okay. Basically, what happens is that when we talk about the impairment of financial assets, so there are basically the model that we follow is called ECL model, which is termed as expected credit loss model. The ECL is expected credit losses. Now, what exactly is this ECL or the expected credit losses model? So let's just try to understand. Basically, what happens is that whenever you recognize an I repeat, whenever you recognize an asset, so if the credit risk is low, so what happens is that you will book 12-month expected credit loss. That means the losses that are expected to arise within the next 12 months, that is what is considered to be the 12 months expected credit losses. Now, the next situation is that in case if the credit risk increases significantly, so what actually happens is that you got to recognize the lifetime expected credit loss. Furthermore, in case if there is a loss event, then you got to recognize the impairment. Now, what is the difference between this recognizing the credit loss and recognizing the impairment? So the difference is basically when you recognize the impairment, then what happens is that you actually calculate the revised carrying amount, and the revised carrying amount, in fact, what happens is that the interest is recognized at original rate. But when it comes to the impairment, the revised carrying amount is used for the calculation of revised effective rate, and the interest is recognized on the basis of revised effective rate. That is what happens. So basically, if you recognize an asset, then a 12-month expected credit loss is to be recognized on all the financial assets. And in case if the credit risk has increased significantly, then it has to be the lifetime expected credit losses. Okay, for example, मैंने बंद किया. For example, ये बंद कर दो. For example, you bought a debenture. Let's say $100,000 debenture is what you bought. 12-month loss was, let's say, 1100. You would say expense debit 1100, allowance credit 1100. This is year one. At year two, the 12-month loss is 1350. You would say expense debited by 250, allowance credit by 250. How did we get this 250 from? It's actually the difference between 1100 and 1350 gives you 250. Now, what actually happens is that, let's say year three, significant change in the credit risk. So if there is a significant change in the credit risk, then what is actually going to happen is that you would simply say that lifetime loss. So lifetime loss turns out to be 22,000. So it's say 22,000 minus 1350. The balance amount has to be recognized in the P&L. So basically, up till now, what have I been doing? I've been recognizing this as a loss allowance. But in case if the impairment loss arises, then you got to actually calculate on the basis of revised. In case if the impairment loss arises, then in case if the impairment loss arises, you got to calculate on the basis of revised expected effective rate. Okay. So any other question? Revised effective rate means that you have to calculate the revised rate. Like for example, the carrying amount was, let's say, 100,000, and now you know that the expected future receipt will be only 40,000 in 3 years time. So now you would actually calculate an impairment loss. You would write down financial asset to 40,000 or even whatever the present value is, and then you would calculate the revised rate, which would actually take the carrying amount to the 40,000, which is the redemption. So then you would calculate the new effective interest schedule using this revised effective rate. Precious, that's how you would do it. Okay. Who else is there? Yeah, Blessing, anything else that you want to know? Okay, good enough. Chandni, now you can go ahead in case if you've got any question.
Hello, sir.
How are
I've
you?
got a list here. Could you please do an overview of the derivatives part in terms of how are they measured and, you know, the types there are?
Okay. Do you know what are derivatives?
Yes, financial instrument.
No, I mean, do you know what derivatives are? Those that actually, I mean, there are 3 characteristics that their value changes with the value of the underlying item.
Yes.
They require initially no or negligible investment and they're settled at a future date, right? Do you know that?
Okay. Yeah.
Okay, so what is it that you need to know with respect to derivatives?
So in terms of the cash flow derivative, embedded derivative, and there's another one. How are the gains? Because the gains, some of the gains go to OCI, some of them are recycled back.
Okay,
to
so you
P&L?
actually are interested in knowing about the hedge.
Yes, yeah.
Okay, you see what happens is that there is one of them is, have you studied from me earlier? I mean, any subject?
No, but I've been dipping in and out of your these live classes.
Okay, because I actually had a similar, you from India or what?
No, the UK.
Okay, from UK. Okay, I had a student from India with a similar name. Anyways,
Okay.
now you see, there is a one hedge which is termed as a fair value hedge. Now, what is that fair value hedge? Fair value hedge is when you try to actually hedge against adverse movements in fair value of recognized asset or a liability. Like for example, you have an inventory and the cost of that inventory is, let's say, $12 per unit, and you're expecting that the price of the inventory is going to go down to, let's say, $10 a unit. You enter into a forward contract to sell this inventory at $10.8 per unit. So this agreement which you have entered into, this is going to be considered as a fair value hedge. So under fair value hedge, what happens is that as per the IFRS 9, what we do is that we remeasure the hedged item and hedging instrument to fair value at each reporting date, and the gain or loss is recognized in the P&L at each reporting date, and the gain or loss is recognized in the P&L. So now what does it mean? This actually means that although under the normal circumstances, inventory is always recorded at the lower of cost or NRV, right? So for example, if this your cost was $12, and let's say if the price of the inventory goes up to $13, so if this inventory is subject to fair value hedge, you would recognize a gain of $1 on this inventory, because the IFRS 9 fair value hedge accounting is going to apply. Always remember, the hedge accounting is going to bypass all the accountings that are actually done on an asset or a liability, because the hedge accounting is entirely different. It's completely different to what completely different to what a normal accounting is. So normally we would recognize the asset at lower of cost or NRV, this inventory. But if the inventory is subject to hedge, so you would continue to measure this inventory at the fair value. It could be increased, it could be decreased, both of them are going to be recognized. Similarly, this forward contract which was being used, you would measure it at fair value. You would recognize the gain or loss on this forward contract also into the P&L. So that is what you would do under the fair value hedge. Is that okay till fair value hedge?
Yeah, that's fine. Yep.
Okay, now with respect to the cash flow hedge, what actually happens is that the cash flow hedge is that when you've got a highly probable future forecast transaction and you wish to protect against adverse cash flow movement, then that is going to be considered as a cash flow. So if you've got a highly probable future forecast transaction and you want to protect against the adverse cash flow movement, then that is going to be considered as a cash flow hedge. Like for example, you might actually buy a machine and you would wish to pay for that machine. Let's say the machine is expected to be of $100,000. You're based in Europe. Now you're expecting that you might actually be required to pay. Right now the rate is let's say 0.8. So that means 80,000 euro is what you are expected to pay in the future right now. But in case when you actually end up buying, I repeat, when you end up buying, you may end up paying 85,000 euros. So what exactly do we need to do? I repeat, what exactly do we need to do? So IFRS says that if you try to hedge this type of a transaction, it's a cash flow hedge. And under the cash flow hedge, what happens is that the effective portion of hedge is recorded in OCI and the ineffective portion is recognized in the P&L. What do you mean by effective portion? What do you mean by ineffective portion? Let's try to understand that. For example, this is machine. This is derivative. For example, this is machine, this is derivative. The machine was originally, let's say, of 80,000 euro. The derivative, let's say, had a value of 0. Now the machine is gonna be, let's say the machine now becomes 82,000 and the value of the derivative becomes, let's say, 2,100. So what happens is that the machine has not been purchased, so it's not there in our books because we intend to purchase this machine. We have not purchased this machine till now. This derivative is actually there in our book because we are exposed to the movements in the value of the derivative. So there is a movement of 2,100 in the derivative and there is a movement of 2,000 in the machine. Now the 2,000 is the effective portion of the hedge and 100 is the ineffective portion of the hedge. So this 100 is going to be recognized in the P&L, and this 2000 is going to be recognized in the OCI. That is what you got to do. Do you get it now?
Yes, I do, sir. Is there another one, embedded derivative, or is that the same?
Okay, I have a video prepared for the embedded derivative. What
Okay.
if I share that video to you? Would that be fine?
Yeah, that would be wonderful. Thank you. So
Okay, are you
sorry.
in any of the WhatsApp groups? Are you in
I
any of
am,
the
yes.
You are, right? So I'll just try to extract that embedded derivative video, and
Yeah.
I'm going to share that embedded derivative video with you so
Yeah.
that you have an idea, right?
Yeah. So sorry. So here I understand this one, cash flow one. If you scroll up slightly on the other hedge derivative, so what is the difference between them? Here you have ineffective and effective part. There you don't have ineffective and effective, right?
Yeah, that's how it is.
Okay.
That's how it is.
Okay. And in here, you just recognize every reporting date, you look at the fair value, and the difference between the fair value, you recognize it in profit and loss account, right?
Yeah, for both the hedged item and for the hedging instrument, both.
Okay. All right. Okay. So one more question.
Yeah, sure.
In terms of sale and leaseback accounting, can you show us an example from the seller? So when you're selling it and then eventually you lease back the equipment.
Okay. There are actually 3 cases with respect to it. For example, let's say you've got an asset with a carrying amount of 1,000, and the present value of lease payment. The present value of lease payment is, let's say, 800. The fair value of asset is, let's say, 1250. The selling price, case number one, the selling price is 1250, which is selling price is equivalent to fair value. Case number 2, selling price is 1000, which is selling price is less than fair value. Case number 3, selling price is 1300, which is selling price is greater than fair value. There are 3 different types of scenarios that you would come across with respect to it. Now see, what actually happens is that, for example, if the selling price is equivalent to fair value, first of all, you need to calculate the right of use of the asset that has been transferred. How do you calculate that right of use of the asset transferred? So first of all, you calculate the right of use of the asset retained. How do you do it? You do it like this: present value of lease payment divided by fair value. So the present value of lease payment here is that 800 divided by fair value, which is 1250. $800 divided by 1250 is 64%. So therefore, right of use of the asset which is transferred is 36%. Right of use of the asset which is transferred is 36%. Now, so what happens is that the gain which is arising is 1250, which is the selling price, minus 1000, which is the carrying amount, is 250. The gain to be recognized in P&L is 250 into 36%. Which is 90 is the gain that needs to be recognized. Now you would say the cash debited by 1250, asset credited by 1000, the lease liability credited by 800, the P&L credit by 90, and then right of use of the asset has to be the balancing figure. The right of use of the asset has to be the balancing figure. Turns out to be what? Let's try to calculate what does it turn out to be. Okay, it turns out to be 640. And this 640 could have also been calculated, right? Carrying amount multiplied by ROU retained. So 1000 multiplied by 64% would have also gotten you 640. Now I'm going to zoom it out because there are 3 different types of scenarios which need to be dealt with it. I am just zooming it out just to make sure that you are able to understand the whole example. Now kindly just look at it and confirm to me that this is okay for you.
Yes, sir, that's fine. Yeah.
Okay. So now, what happens is that this was the selling price is equivalent to fair value. Now there is a second case, which is the selling price is less than fair value. Now what actually happens is that selling price is 1000. The fair value is 1250. So if you see, I have actually lost 250. Okay, FC, don't worry, I'm just gonna share this PDF. FC, don't worry, I'm gonna share this PDF. Don't worry about it. Just try to focus on understanding. I'll share the PDF. Okay, so that means you have given them a loan of 250. Like it's similar to like you could treat it as a down payment. I repeat, you could just treat it as a down payment. You could treat it as a down payment. So our PV of lease payment has to be now 800 plus this 250, gives you 1050. So right of use of the asset which is retained is going to be 1050 divided by 1250. Because you see, we had an asset, we sold it for less than 250 of its market value. So that means we have actually 84% is what it is going to be. And when 84% is what it is going to be, so resultingly 16% is the transferred amount. And then the P&L gain is going to be, calculated on the basis of the fair value of 1250 minus the carrying amount of 1000, which is 250. You multiply it by 16%. Gives you 40. Gives you 40. Similarly, when the selling price is more than fair value, so other way around, this additional 50 is the advance that we have received. So our present value of lease payment, which is of 800, has to be adjusted for this 50, and 750 is what we have paid. And accordingly, you'd calculate the right of use of the asset transferred and accordingly the gains and the losses. Yeah, is that okay to everyone now?
Yes, sir. Yeah, that's fine.
Okay. You have any other question?
Yes, please, sir. With regards to deferred tax standard, could you give an example of when a tax asset arises and a tax liability arises?
Can you just repeat? What do you want me to do?
Yeah. So in terms of deferred tax standard, could you give an example of the temporary tax differences when a tax asset arises and a deferred tax liability arises?
Okay, there could be multiple cases. You see, what happens is you got to remember. Yeah, please. You got to remember some rules for the assets. For the normally the assets, if the carrying amount of asset is greater than its tax base, then the difference is taxable temporary difference, and then everything is vice versa, which is if the carrying amount of asset is less than tax base, then it's a deductible temporary difference. Now carrying amount of liability is greater than tax base, it's a deductible temporary difference. Carrying amount of liability is less than tax base, it's a taxable temporary difference. When you've got a taxable temporary difference, you multiply it with the tax rate, you end up getting deferred tax liability. You've got deductible temporary difference, you multiply it by tax rate, you get a deferred tax asset. Now, there's something that you need to understand, which is that if you remember this one rule, all other rules are opposite to it. All other rules are vice versa. So for example, if you've got a PPE, the carrying amount of PPE is 1000, the tax base is 950. So that means this 50 is going to be taxable temporary difference. You multiply, let's say, by 30%. 15 is the deferred tax liability that you get. But similarly, if the carrying amount of the asset is 1000 and the tax base is 1150, so this 150 is a deductible temporary difference, multiply 35, maybe this 45 is the deferred tax asset that will have. 45 is the deferred tax asset that you will have. Thank you very much, Kamanda Lira Isaac Firi. Thank you for your time. Thank you for attending the session. I hope it was fruitful for you. So Chandni, what you need to do is that you need to actually review, you need to remember these rules and you got to apply to the given scenario, and you would actually be able to identify whether a deferred tax asset or a deferred tax liability arises. And as I told you, there's actually one rule that you have to remember and the rest of the rules are just opposite to it.
Thank you, sir.
Anything else that you would want to know?
No, I think I should give other people a chance. Sorry, sir. Thank you.
No, I think basically the questions that you would have asked, many other people would have been expecting to ask this question. So it's
Okay.
beneficial for all. That's why I just told people that you may stay back because everyone is going to benefit from the questions that others would ask. So I now have got Esther Suka. Esther Suka, do you have any questions?
Hi, good evening.
Good evening. How are you?
I'm good, thank you.
You're from
Yes,
where?
I'm from Zambia, Africa.
Okay, good.
Yes, would you highlight a little bit on the cash flow statement? Like, what are the pointers that we need to look out for in the cash flow statement?
Okay. You see, what happens is that when we talk about the normal cash flow question, we have already studied the similar type of questions at the FR level for the cash flow. But here at the SBR, you have got the group cash flows that are examined. And when we have got the group cash flows that are actually examined, so there are a few important adjustments that you need to keep in mind. The number one of them is basically with respect to the goodwill. You see, what happens is that when you prepare a T account for the goodwill, you've got opening goodwill, let's say 1,000, you've got closing goodwill, let's say 1,200, and you've got an acquisition, which is, let's say, of 500. You've got a disposal of a subsidiary, and there the goodwill was 150. So now what happens is that with respect to this group cash flows, you got to identify the balancing figure, and that is probably going to be the impairment of goodwill. That is probably going to be the impairment of the goodwill. That's one thing with respect to the group cash flow that you would have to keep in mind, that that this is what the impairment loss is going to be, and you got to adjust this in the cash flow. One thing. Similarly, when you would have the associates, you would reconcile the associates, the investment in associate. This is the opening investment. This is the closing investment. The acquisition of associate, the disposal of associate, the profit share from associate, the loss share from associate, and the balancing figure in a lot of case is going to be the dividend that the associate has paid you. So you would have to actually identify the dividends that would have actually received. So that is the dividend received. That is actually going to be the dividend received. I mean, that is actually going to be the dividend received. So that's the second adjustment that you would have to keep in mind.
Okay.
Now, at times what happens is that when we acquire a subsidiary, so what could happen is that if you issue the shares, they are non-cash, ignore them. If you issue debentures, they're again non-cash, just ignore them. If you pay cash, let's say you paid a cash of 100,000, but on the subsidiary's balance sheet, there was a cash of 30,000 that was available. So what you would do is that you would only show the net cash in your investing activities. You'd only show the net cash in your investing activity. That is something that you would have to. Now, what next is there? The next situation is, that when we talk about the movement of inventory, PPE, payable, receivable, etc., there is something that you need to understand. Normally, what we do is that we say opening, let's say opening payable is, let's say, 50,000. We say closing payable is 65,000. So we say that there is actually an increase in payable of 15,000. An increase in payable is going to be recorded as an addition in cash flow from operating activity. Normal. This is a normal treatment. But in case of a subsidiary, in case of a group cash flow, you would have to see that has there been any movement because of acquisition? Have there been any movement because of the disposal? So let's say you acquired a subsidiary and there is a 22,000 payable available on that subsidiary. So what you would do is that you would say that means the opening was 50,000. The acquisition led to an increase of 22,000. So the opening needs to be adjusted and it has to become 72,000. And now the closing is 65,000. So there is actually a decline of 7,000 in the payables. So instead of showing a 15,000 increase, we are actually reaching out a decline of 7,000. We're actually reaching out a reduction of 7,000. So I repeat, we are actually reaching out a reduction of 7,000. Do you get it now? And similar type of adjustments need to be made with respect to the other things, like the receivables, the inventories, the PP, etc. Whatever the addition or the deletions is, whether the acquisition or the disposals, you got to adjust it, you got to incorporate that.
All right, thank you. So another question I would have is if you could highlight just a little bit on the management.
Can you just please speak a bit loudly? Sorry.
Okay. I was saying if you could highlight a little bit on the management commentary. Just
Okay.
to see what are the key points.
Okay. Good enough. Now see, what a management commentary is, that there is actually a practice statement that has been prepared by IASB. Generally speaking, what happens is that in some of the jurisdictions, an entity is required to give the management commentary, which is mandatory. And in a lot of jurisdictions, the management just tries to speak to the shareholders through the communication along with the financial statements. So when the management actually discusses with the when the management actually communicates a lot of things in the financial statements, so it was felt that the need is required to identify that there are few things that the management should highlight in their communication. So for that, the concept of management commentary was introduced. And when the concept of this management commentary was introduced, it was actually like this, that that it provides a guidance on how the management commentary needs to be prepared. Like if the management wants to discuss things other than the financial statement with the shareholders, so what are those other things that the management has to discuss? So that's what the management commentary actually includes. And basically it depends upon what type of, I repeat, it depends upon that what type of jurisdiction you are operating in, and then on that basis the management actually is required to give the appropriate I mean, whether they have to follow the management commentary practice statement laid down by IFRS IASB, or whether they don't have to. So that is how things go about.
So in the management commentary, would it be appropriate to include all those other details, say the query, the challenges that the management is having in running the organization?
Yeah, whatever they want to discuss other than the financial statement, that's actually given in the management commentary.
Okay, all right, thanks. And the last question would be on is it the employee benefits, where there's the market condition and the non-market condition. And then in the situation where they are given the market condition, they say they'll be given the right to exercise their shares when the market price, share price rises, and then peradventure the share price doesn't rise. So how do you account for those shares that have been promised to the employees?
Okay, can you just repeat? Basically, you are saying that the share price rises. You've got a share-based payment. How, I mean, like what happens? The share appreciation rights that you're talking about, that the value would increase and they would get the cash equal to the increase in the value. Is that what you're asking?
I'm asking in connection with the market conditions. Say when the share-based payment is given, there is the conditions that need to be satisfied. So focusing on the market conditions where the directors or the employees do not have direct influence.
Okay. So
So
you see, what happens is that with respect to the market condition, you got to ignore the market condition. Like the expense has to be recognized irrespective of whether market condition is met or not. I repeat, the expense has got to be recognized irrespective of whether market condition is met or not, provided that other conditions are met.
Okay. All right. Thank you very much. I think for now, this would be all.
You're most welcome. And
Thank you.
thank you much. Now, I've got Eunice Mukwada. I'm sorry if I'm pronouncing your name incorrectly. I'm really sorry for that. I think it's Eunice Mukwada. चाय बनाइए क्या? ग्रीन दे दो बस. Okay, FC, you can ask because probably no response from Mukwada.
I just need to ask, in terms of the conceptual framework, can you just highlight the key components? I think you spoke about something about measurement and, well, I know probability, but is there anything else that we should know in terms of, just a summary of the conceptual framework?
Can you just repeat, please? Sorry, and can you be a bit loud? Sorry, really sorry about it.
Okay, I was saying in terms of a conceptual framework,
Yeah.
can you highlight a few, well, key components? I think you mentioned something about measurement is a key area within the conceptual framework. Is there anything else in summary?
Are
that,
you are you in any of the WhatsApp group?
Yes, I am.
Okay. Do you know my number?
Well, I suppose I do. It should be in the groups.
Okay, just wait a bit. I think I'll just wait a bit. I'll just try to make sure that I conceptual framework. Okay, it's done. Then what happens is that there's this ethical issues. Ethical issues. There's this sustainability reporting. Share copy. Sustainability reporting. And okay, I'm just forwarding this message in the WhatsApp groups. I probably after this exam attempt, I would probably have to just filter out few of the WhatsApp groups because there are many WhatsApp groups for SBR that are actually there. And it's majorly 1, 2, 3, 4, 5. 1, 2, 3, 4, 5. Yeah, it's out. Michelle, are you not in any of the WhatsApp group? Okay, if any one of you is not there in the WhatsApp group, you could just message me on this number. It's plus 9233123666161, and I'm just gonna add you up. Anyone who is not there in the WhatsApp group, just message me, WhatsApp me on this number. I will add you up.
In addition, as well, I was also thinking with the number of examples that you have, if you have any which actually carry a financial, an IFRS 9 example.
Yeah.
In the list of what you just, the list of questions.
You want, you want an example on IFRS 9?
No, I'm just saying in the list that you gave us, do you have any with IFRS 9 components in there?
I don't think so.
You're not sure? Okay.
I just wait a bit. I think I can help you out in that.
Well, perhaps maybe you can include maybe a short, a short question in there.
Yeah, I'll just
Thank
try
you.
to, because I think I have got something which I can possibly share. Okay, I've actually, because you see what happens is that as soon as the students, they keep on asking questions, the things they come up, they start coming up before, because if you people don't ask, then probably I might not be able to share a lot of things, unfortunately, but here you people are asking. This is really good to see. Okay. This is the IFRS summary playlist. SBR playlist. Okay, yeah, I've got that. I've got that. You would love it. You people can, like whatever your weak areas are, you people could probably go through them. And I'm sure the questions that the others are asking, that would also be helpful for you. 3, 4, 5, 6, 7, 8, 9, 10. I've shared, when you would actually go through one of the SBR playlists, when you would go through the SBR playlist that I've shared, there is an ample amount of examples for the for this IFRS finance instrument also. SBR. Okay, you've got any other question? Okay, good enough. Thank you, HC. Okay, Julie, give me time after the class. I'll share this current issue and the exposure draft. For Jean Michel Leong, you're asking that what is the difference between non-current asset held for sale and discontinued operation? Now, see, discontinued operation is basically a component of an entity that has either been sold or is classified as, that has either been disposed or is classified as held for sale and represents either separate major line of business, geographical area of operation, or a subsidiary acquired exclusively for resale. And what is it? See, basically what happens is that if you are planning to dispose of an asset, whether that could be a subsidiary, that could be a segment, that could be a division, it could be classified as a held for sale. But would it be classified as a discontinued operation? For it to be classified as a discontinued operation, it should represent a separate major line of business or a geographical area of operation. That is what it should do. So like for example, you are an entity which has got multiple types of businesses. Now what has actually happened is that you have actually, you had an investment in textile and there was only one single company of textile that you had, and that was a big company and you have decided to dispose it off. So that is going to be discontinued operation. But if you had multiple textile companies and you disposed of one, that is not a discontinued operation. Okay. Yeah, the treatment of discontinued operation is that it is presented as a separate business in the P&L. But for the if a business is not a discontinued operation, then you don't present it separately in the P&L. Nadesan, okay. Have you checked out one of the video on the portal on the question on the alternate performance measures? Have you checked out a video? Okay, what issue are you having with respect to this alternate performance measures? What issue are you having it? Okay, okay, let me give you a bit of a guidance here. Basically, what happens is alternate performance measure is a topic, and normally we do calculate the financial ratios like profitability ratios, liquidity ratios, gearing ratios, investor ratios, etc. We do calculate different types of ratios, but at times there are actually the situations where you need to have the alternate measures also. Like for example, there is a ratio called EBITDA, the earning before interest, tax, depreciation, amortization. It's a measure which is close to cash flow. At times you've got the asset turnover ratio, which you calculate. At times you've got the cash flow over operating profit. So there could be multiple types of other ratios. At times you have got ratios which are non-financial in nature. So the concept of this alternate performance measure is that basically an organization has got different types of stakeholders. And when the organization has got different types of stakeholders, so each and every stakeholders has got a different demand, has got a different requirement. So all that you have to do is that as an entity, you got to be able to represent or present the information so as to suit the requirements of the different stakeholders. That is something that you have to do. So basically the alternate performance measure is one of those topics where you would actually be required to do the calculation. You would be given the formulas to apply. You would be given the type of ratios that are to be calculated, and then you would be required to evaluate them. Yeah, is it better now? Yeah, Nadesan, are you better now? Okay, who else is there? We've got Fatma Rasana. You want to ask anything? You have already asked what to do till exam regarding practice revision. I feel like I have not prepared enough. Okay. What can I say? All that I could say is that just try to practice the questions of the areas that you know. Don't try to pick up anything new right now, because if you're going to pick up new things, you're going to mess up again. So the areas that you know, just try to review the practice questions pertaining to those areas. Don't try to do anything new right now. Narendran, just don't worry. I think you would have had good idea about how to deal with the questions through today's example, today's class, because today's class actually we did focus upon this. And previously I did conduct around 5-6 questions also about this. On the consolidation, you may actually look at those questions also in case if you wish to. Don't worry about the current issues, just ignore them. When the current issue question comes in, all that you should do is that you should just write down as per the normal standard. Don't try to actually go into anything else. Yin Michelle, do you want to ask anything? Okay, Julie Stenlas. Yeah, my friend Lele Yap, how are you?
Fine, so but I haven't applied for the exam, but I'm still following the whole thing. Well, I'm sorry, sir, I didn't put in for the exam at all. None paper. Probably one in coming December. I'm following your courses because like I said, I find I've got too much gap knowledge and like remembering things is quite hard, I must admit.
So do you actually get what I teach?
Yes, I do. I mean, I appreciate it that there feel some gap, but I feel that I still got loads of gaps. That's the only thing, trying to memorize things like the regulation and the IFRS, the standards.
I think
do
what you
follow.
need to do in addition to listening to the lectures is that you got to just write down the things also, because at times what happens is that when you write down the things, you actually tend to improve your memory. I mean, that is something that you got to do.
Thank you, sir. I do appreciate it a lot. And I say, I wish that I knew you a long time before, quite recently.
Mm. Okay,
I mean,
so
you
keep focusing for the December attempt and stay in touch with me.
Yeah, I'm focusing on that. I already paid for the December, just one paper only. Although I follow you on our APM, because all these subjects are interlinked in the sense that whenever you give the lecture on one side, like APM or AA, sometimes it does give you a clue how to answer on the other paper as well. It helps. And so I always follow your lecture whatever I can, whenever.
Okay, so you have access to the recorded lectures also, right?
Some of them I get them, but some of them I don't. Like I say, I got to check out.
I think because you see, I also have a very busy day tomorrow. I have got, I mean, I'll conduct a similar session for the AFM inshallah tomorrow. So I will not be available tomorrow, but day after tomorrow or within the start of next week, we need to have a Zoom meeting of 10-15 minutes so that we could just reconcile where you are heading towards.
Thank you very much, sir. I do appreciate it. Like I said, I wish I knew a long time ago, but I didn't. But then it's not, nothing is too late anyway.
Yeah, exactly. Nothing is too late. So all the best. Yeah, Julie, would you like to ask anything?
No, I think that all the questions have been asked already. I was going to ask you already. Thank you.
Thank you. You're from UK, right?
I am, yes.
Uh, you attempted that AAA mock?
Yes, that is me, yes.
Okay, I'm really sorry about it because there was actually a problem that actually occurred and I was very embarrassed because I could not meet your expectations in that mock examination review because unfortunately what was required to be done was you had to submit I mean like not just submit, you had to send the questions for the review. And I just got them I mean like because you see, you were not in the WhatsApp group also. You did not even send across any message to me. In fact, you did send across message to one of our admin team members. And I was like, I am unable to find any answer from this student. There was another student from
Yeah, they
there
didn't
was
tell me
another
that.
student from
Yeah, sorry.
Canada. Sorry, yeah, there was another student from Canada. He had my number and he like messaged me twice, and I was like, I went into my technical team even at more, I mean, beyond midnight. It's even 1 a.m. right now here in Pakistan where I'm teaching from. So it was like 2:30 a.m. in Pakistan. I caught up my technical team. I told them that, look, this is this guy. He has submitted the exam and I haven't got it in my tutor portal. So I just want it at any cost. And they just like, they exploded. I said that this guy hasn't submitted. So I said that just send it for review. I'll just review his answer. Then in the morning, I got one or two more complaints. So I was like, I got up with the technical team. I told them that, look, just see if there are any unsubmitted answers exist. So there were many, and that included yours also. And I even sent a one voice note for you also. But my apologies, and I was really embarrassed because of this technical issue. I could not deliver. I delivered to maximum possible student, but really apologies to you for that.
That's fine. That is absolutely fine. But, I mean, I did, as soon as I finished the mock, I sent a screen print on WhatsApp to the admin team saying what's up, what was the problem was, because I had another mock to do and I couldn't really do that one and spend another 3 hours doing another mock and then saying I haven't submitted it. So I did contact it. I wasn't told that I had to send it
Review.
send it off to anybody else. So I would have done that. So if someone told me that, because I did ask before, because obviously it was late when I was actually asking to do the mock, and I asked him, would it be okay? Would you be able to be marked? Would I be able to get to see the debrief? And he said yes. And I wasn't told anything wrong. And the gentleman told me that he had problems. They had heavy rain, and therefore he couldn't answer me back. And by the time I got your message, I'd already taken my exam already. So
Yeah,
there's nothing I could do at that point. So this doesn't matter. It's
my
okay. It's
my
okay.
sincere apologies for that. If you could just, you have my number. Can you just WhatsApp me?
WhatsApp you.
Yeah,
Yeah,
you have my number, right?
I have now.
Yeah, so you do WhatsApp me. I want to talk to you again.
Okay. All right. There's no problem. I mean, it's something I could do now. Anyway, it was by the time I got your message, it was like it's too late. I'll come back from my exam and then thinking, well, this message is not going to really help me now. I've already taken the exam now anyway.
No.
So yeah.
No,
It's all right.
that's really nice of you. I mean, I know I can understand that at times it becomes disappointing and at times it becomes frustrating that you're not getting response. But my apologies and sincere apologies. But you do message
It's
me. I want
fine.
to talk to you.
Okay.
Okay, Matlodi Mazobi.
The only other
Thank you,
question I wanted to
Vishwa
ask,
Singh.
sorry.
Sorry, yeah, Julie, please go ahead.
So the only other question I wanted to ask, on the last exam we had, they had a lot of it on deferred tax, and a lot of it was to do on group accounts on deferred tax. I didn't know how to even answer that. I've never seen a question like that before.
You did not know how to answer that for the group accounts?
No,
The
because
deferred
they had
tax?
like deferred tax on it. A lot of it was they had a lot of deferred tax on group accounts, and I hadn't ever seen that before.
Okay, you see what happens is that from the group accounts, there are majorly 2-3 implications of the deferred tax. Vishwa Singh, thank you very much for your feedback. Thank you, much appreciated. Now, from the group accounts, the deferred tax, there are actually the multiple implications that you got to understand. One of them is like, for example, you have a subsidiary. The carrying amount of the net assets is, let's say, 100 million. The cost of acquisition is, let's say, 120 million. So we would say the goodwill is 20 million, right?
Mhm.
Now, what we are being told is that the fair value of net assets is 115 million and the tax rate is 30%. So what you actually got to do is that you got to say this thing that 120 is the cost. And then what happens is that the carrying amount of the net assets is 100. The fair value adjustment is 15. And then the deferred tax liability is basically 15 into 30% gives you 4.5. So this is now going to be the net amount that on which you would be talking about. So it's 115 less 4.5 gives you 0.5, and that 120 minus 0.5 gives you 9.5. So basically, if the deferred tax implication comes into the group accounts, that's how you are actually going to be handling it. You're gonna be what? You're gonna be saying that, okay, whatever the fair value adjustment, if this gives rise to a deferred tax liability, that's how we're gonna be accounting for the deferred tax liability here. So it would impact your goodwill. Your goodwill calculations would have this implication of deferred tax of 4.5. Basically, it's the fair value adjustment multiplied by the tax rate. That's how that adjustment is going to be. That's one thing. Now,
So,
the
Steve,
second
say
thing
that again
is
a bit-
that,
Sorry. So that
Yeah.
last bit again about the goodwill, please. Sorry, I didn't catch that last bit.
okay, you see, if I normally would have done this 120 minus 115, the goodwill had
Yeah.
been 5, right?
Yeah. Mhm.
But what happens is that 120 minus this 115 is the fair value of the net assets, but again 4.5 is the deferred tax liability that has arisen. So resultingly, it becomes 110.5, and hence the goodwill becomes 9.5, because what happens is that whenever there is a fair value adjustment, there is actually a deferred tax liability that arises on the fair value adjustment. So you got to
Right.
incorporate the deferred tax liability also.
Oh, okay. Okay. Thanks for that.
You see, that's one thing. Now, the second one of them is, for example, we calculate the unrealized profit. For example, there is a $20 unrealized profit. So always remember that there is going to be a deferred tax asset that would arise on the unrealized asset. How $20 multiplied by whatever tax rate is 30, let's say. So 6 million is going to be the deferred tax asset that you would book on this. So like if you've got unrealized profit, the unrealized profit would lead to a deferred tax asset to be recognized. Now, I don't have much time to get into the logic, but I'm just telling you that you got to keep this in mind.
Okay. All right. That's all I want to know then. Thank you very much.
Yeah, thank you. Now, who else is there? It seems that you people have just piled up every single thing for the last day, and you people have been very, very silent in the whole WhatsApp groups. It says that you've piled up everything for this live session. Now, Mathalodi Mozubi, I'm sorry if I'm pronouncing your name incorrectly. Okay, there is this Oladitan. I'm sorry, Oluwa Tosin Oladitan. Okay, then we have got Precious OG. We have got Precious OG. Okay, we have got Tupista. Kiwanuka. Theopista Kiwanuka.
Thank you so much for the live webinar. It has really been useful. I really have no question. All I had has been asked, and I'm going to also check through what you've shared on the WhatsApp group. Thank you so much. We are
Thank
just
you very
hoping
much.
for it tomorrow.
Thank you. Thank you for your feedback. Thank you very much.
Welcome.
Okay, Precious, thank you very much for your feedback also. Thank you, Jean Michelle. Yeah, Christopher Jamosa, this is actually a revision session for the September. Are you attending in September or December? Yeah, Christopher, are you attempting for September or December? Okay, I think there is this one, I'm sorry, I pronounced the names incorrectly, I really feel bad. Okay, so you have any question, Christopher? Now, Ihram Mawo Nedzo. Ihram Mawo Nedzo. Do you have any question? Yeah, there is this one final student, Robinson. Do you have any question? Yeah, you could just go through the tech. In fact, if you have got a Kaplan book, there is a chapter in the Kaplan book. You could just review that chapter. That is going to be more than enough. Harriet Howley, do you have any question?
If I do not have any question, thanks. I will be writing in December, maybe. I couldn't write this time. This time I wrote IPM following your lectures. Thank you.
Okay, thank you, Ephraim. Thank you. You're Ephraim, right?
Yes, Ephraim. I left a P there. I forgot. I
Yeah,
misspoke.
that's what actually made me difficult to you. You attempted an excellent mock. I really loved your mock. I mean, like it was the best mock that I actually reviewed for APM. It was an amazing mock that I went through.
Oh, thank you very much. I really appreciated your feedback, and I hope it motivated me in the exam. I also hope I replicated what I did during mock.
Yeah, inshallah, because I mean, like it was, I was surprised. It felt to me that as if you had the book open in front of you and you've been writing down the answer, because they were such wonderfully articulated answers. I really enjoyed going through that mock. In fact, you see, it took me approximately 45-50 minutes for every single mock that I actually marked, along with preparing a separate 4, 5, 7 minute video for every student. And it was the best ever mock that I reviewed. It took me around more than, I marked around 37 mocks on APM.
Yeah, you were quite busy, and I really appreciated your feedback. I listened to your voice note, and that really gave me encouragement. You are doing great work. Thank you.
Yeah, thank you very much. Thank you.
Thank you.
Okay. Amina, thank you so much, sir. Just one more question. In one of the technical article, it said that to calculate impairment to include these liability in the carrying amount. How does that work, sir? Yeah, very simple. Basically, you see, if there is a subsidiary for which you are calculating the impairment, you got to include all the assets and the liabilities. You got to include all the assets and the liabilities before you calculate it for impairment. You cannot calculate the impairment without including all the assets and the liabilities. Thank you, Julie. Yeah, I'll be waiting for your message. Just message me. Would get in touch with you after exam. Yeah, Harriet Hall. You have any question? Wahib Abdul Rahim, you have got any question? Okay, guys, thank you very much for your time. Thank you very much for being part of this session. I hope that you people would have enjoyed this session, and inshallah, I wish and I pray for all of you that you will inshallah be able to pass in this specific examination. And